Okay, so what we're going to do is we're going to launch into this program today, which is, it was meant to be a relatively small topic, but it is clearly a topic of great interest in the public, which tells me that it may not seem as simple as I think it is. So I'm going to try to educate you on what required minimum distributions are out of your retirement accounts, how they work, how to manage it, and the implications if you don't manage it. So you have to really be aware of it, and I hope that this is a really informative program. Throughout the years in your life, you've accumulated money in retirement accounts, presumably. And you've done so in a tax-deferred fashion. So not all of your savings is tax-deferred. You may have joint accounts or trust accounts or individual accounts that are already taxed money. But you may also have retirement accounts, old 401ks or an IRA, where you've actually accumulated money and you've never paid tax. So the government set these up, I'm not going to give you the exact year, but I think that the origin was sometime in the 80s. I think that was the tax law changes happened at that point. The transition from pension plans to saving for your own retirement was part of this process. So IRAs were developed, and people put money into them and received a tax deduction. So they essentially put money in without ever paying tax. And essentially Congress said, at some point in the future, we need to collect the tax on your retirement savings. So you're essentially getting to what I call the other end of the spectrum. It's now time at a certain age, and Congress has set this certain age as 70 and a half, the year in which you turn 70 and a half. There is a reason for the half, but I'm not going to get into it unless I am undisciplined in my talk. That at that age, you need to draw out a minimum amount based on a calculation that I'm going to show you, and you're going to have taxable income. So we're kind of going from the early days when you're saving to now the point where you're distributing the money, and the government's forcing it out. And they're forcing it out because they want their tax dollars. That's the big story there. I'm going to give you the big warning first so that we make sure that we don't make a mistake. The penalty for not taking out your minimum distribution out of your retirement accounts is massive. It's actually 50% of the amount that you failed to take out. Now, that's a humongous fine penalty, and while I don't work for the IRS, I've never dealt with the IRS in this circumstance, I can say that if you have a good reason for having made the mistake, a justifiable reason, that could be a health issue, it can't be ignorance. It has to be something that the IRS would say this was an extenuating circumstance. You can ask for forgiveness and a waiver of this penalty. And anyone who's made the mistake, clearly I want you to talk to a tax attorney, and I would want you to draft that waiver request to relieve yourself of this kind of a penalty. But the reality is ignorance is not going to work. 50%, half of the penalty, and that can be thousands and thousands of dollars of penalties. So the importance of this talk is if one person was about to forget, I may have saved you thousands of dollars. Okay, so I'm going to give you a very high-level view of how this works. And this is not a complex thing. I don't have millions of slides here. But what I want to show you on this slide in particular is that the calculation is really simple. It's saying take the total value of all of your IRAs, and when I put IRAs under that umbrella, I actually mean anything your IRA owns or that an IRA is owning. For example, you may have an annuity that's held inside of an IRA. That IRA, that annuity, in some cases, if that annuity is not paying out as a lifetime payment, so if it's still in a deferral stage, it counts as an IRA asset. So it's not just your individual retirement accounts. And when I say IRAs under that umbrella, I also mean your retirement accounts that you might have with a former employer, a 401k, for example, or a 403b. these things all count as tax-deferred assets. And that's what we're talking about, tax-deferred assets. At the point at which you reach 70 and a half, you're going to have to do a calculation. So the key things on this chart are the total value of everything that's in a tax-deferred state divided by a number. And it's called the distribution period in this particular chart. But that number is actually prescribed by the IRS. There's a table that is published. It's publication 590, and it is, they call the Uniform Lifetime Table. And it actually says at age 70, your divisor is 27.4. So that's what you stick underneath the total value is 27.4. So you're taking everything you have and you're dividing it by 27.4, and it gives you your number. What is that 27.4? There's some actuarial math going on here. I was a former actuary, so I just love to use the word actuarial. So the actuarial math here is that it's your expected lifetime together with a generic spouse. This is what as my research has looked into it, because I've never really dug into what this means. It's you and a spouse who's 10 years younger, combined together your expected lifetime. That's what it is. So the government said, we want all this money to be distributed out over the expected lifetime that you have left from age 70 and on. Okay? Then you get older by a year. So now you're 71. Your divisor is going down. So I don't know how many of you are somewhat handicapped when it comes to math, but the lower and lower the divisor, the bigger the chunk of the money that needs to come out. And as you can see, as you get to be age 100, if you got lucky enough, or unlucky enough, depending, you would have a factor of 6. Now, you can see, you get to be 100, well, you know, the life expectancy probably isn't 6. But again, we're talking about joining you together with a hypothetical spouse who's 10 years younger. So that's why it's a little bit high there. The point is, that's 16% of your portfolio would have to come out at age 100. Way back at age 70, the answer is 3.6% of it. So a little bit comes out in the beginning, and it grows as a percentage. And it doesn't mean you spend it. I want to make sure that this is clear to people. When the government says you have to take money out of your IRA, they are not actually adding another sentence to that says, you must now spend that much money. They're just literally saying, take it out of all of your tax-deferred accounts, give us some tax dollars, because you haven't paid any on this money, and go ahead and put it in the bank, put it into an investment account if you want, in an after-tax account, do whatever you want with it. The reality is all they care about is their taxes. They're not giving you an indication of what you can spend sustainably. You know, the idea behind this is that, yeah, these factors would imply that you could spend 3.5%, and it will continue to grow and grow and grow to the point where it becomes a very large percentage of the portfolio as you get older. Yeah, if you're interested in trying to deplete your portfolio, this is a guide of how to do it. It's giving you a guide of how much each year you could spend and still be left with something at the end. The reality is there's a lot more to that calculation of what a sustainable withdrawal is in life. It's not based off of a simple table from publication 590 of the IRS code. But this is the calculation. It's pretty simple. A couple of things I'm going to point out on this is some nuanced rules. You turn 70 and a half. It's the year in which you turn 70 and a half. The total value is from the December 31st of the beginning of that year. So let's just put it in terms of today. I turned 70 and a half this year. So my 70 and a half birthday, let's say, is in June. I then have to add up all of my tax-deferred accounts, find out what the value of them is in total, and I do that value as of the statements from December 31st of 2016, so 9 months ago. Makes sense because you don't know the value of it on December 31st, 2017, because it hasn't happened yet. So you're using all of those old statements. Another little rule I want to point out is when I told you the total value divided by that number, 27.4, tells you what you have to distribute, you are not required to distribute it out of each one of these in proportion. You don't have to do the calculation 3 times over or 4 times over or 5 times over. You can actually calculate it in aggregate, and you can decide to take it out of one singular account if you feel like it. The only thing I would caution against that practice, and we do this at my firm because it's an important issue. Imagine the 50% fee when you actually trusted your advisor to do the calculation and make sure it's executed. So well, Gene knows it's a stressful thing that I make sure is stressful all the time, is that if you don't take it out of each one in the proportion that it implies, you have to remember that you took it all out of another one. And I can tell you there are times in life where you're going to forget that I took it all out of this one, so when I go to look at the other 3 and realize that I haven't taken out my required distribution, that I'm okay. That added element of stress of thinking, did I forget? And having to go back and retrace your steps. And imagine now you're retracing your steps with accounts that have been closed, transferred to another custodian, a new manager took over, they see 3 of them where nothing's ever been taken out. You can imagine you could create some confusion. So it's very important to keep your records to show that you actually did it for yourself. And it's really records for yourself. It's also records to make sure that the IRS knows you did it. These custodians, the Schwabs and the Fidelities, they actually do produce reports for you and show it to you and present those reports to the IRS as well. So everybody's watching. I just want to make sure that if you take it out of one, it may not be as easy to track what you've done, okay? So this is another chart just to kind of give you that idea of aggregating it up. An example calculation, 3 separate IRAs, 12/31/2016 balance. You add it all up. In this case, it added up to 100,000. It's divided by the IRS's life expectancy. That's that chart that I showed you. And that'll tell you what your required distribution is. So that's all what we're doing. And then you can take that number out of any one of them, singular accounts that you want to take it out of. You have to, or a little out of each, or a little out of each, exactly. Now, next little rule, and I don't want to get too far ahead in my slides, so let's just see what happens. Oh yeah, this is perfect. So clearly I put these slides together in a perfect order. Special first year rule. You turn 70 and a half, that's the trigger year. You do your calculation and it says you have to take out $25,000 out of your account. So you have like a really big set of IRAs, okay? It's taxable income, $25,000. The very first year, you're allowed to wait around until the following calendar year by April 1st to take it out. You don't have to take it out if you turn 70 and a half this year in 2017. You don't have to take it out in 2017. You can take it out all the way up to April 1st of 2018. But this is a really important point. That's your first required distribution by April 1st. Your second one is due by the end of 2018. So now you're facing 2 $25,000 distributions. And that all gets bunched up into one tax year. So the idea, I suppose Congress and the IRS put the idea together was, you know, the year in which you turn 70, which seems like an not necessarily old today, but back when they put these rules in place, that's kind of old to necessarily have a job still and earn, you know, your higher wages. They probably wanted to make it so that you could take your first RMD and your second RMD in a year in which you're not working anymore, as if somehow the 71st year is the year that you've retired. Maybe the congressman put that in place because the people on the committee actually were in that circumstance and they had very large IRAs. I don't know. But the second IRA distribution, or excuse me, the required distribution, number 2, is really important to understand that you're going to double it up. And if you double up your income, required distributions in one tax year, you may find that you're actually going to have a higher tax bill. You may push yourself into a higher tax bracket. And I'm going to talk about a couple of other implications. But before I do, I can tell you my default with my clients tends to be that you take your first distribution in the calendar year in which you turn 70 and a half. Get the first one out of the way in that tax year, then do your second one by the end of the year. It doesn't matter when you do it. You have to just do it by December 31st of every single year thereafter. Okay. And you can take out monthly payments if you're planning to live off of money out of your IRA, and that will help to satisfy your required distribution. Or you can take it in one lump sum, stick it in a savings account or an investment account, and draw from that account to live your life. There's no real magic there of how frequently you want to take it out. So we tend to, in most cases, take it out in one lump sum, get it done, know that you've satisfied your required distribution. Now, I will say, if you're in a position where you are requiring your budget requires you to take out more than the minimum, well, then you're pretty much satisfying your required distribution just through your normal daily habits of what you need to live your life. It's really only when you're not burdening your portfolio, your tax-deferred accounts to some large degree that you have to really worry about this. I will say, once you've set it up the first time and you've done your first distribution, custodians, all that I'm familiar with, that I've worked with, they actually calculate from that point forward your required distribution. And so you can actually see it when you log in. You can see, have I satisfied my required distribution? You can schedule your required distribution to happen in an automated way as well, which we do as well. So the idea is automate this so that you don't make a mistake. The custodians care about it as well. They feel, custodians, I'm talking Schwab's, Fidelity's, banks, they care about messing up too, because if they mess up and don't provide you with enough guidance on this, there's a very large liability here to the IRS. They want to make sure they're covering themselves. So they're going to help you along to make sure that you don't make the mistake, because they're afraid that you're going to come knocking on their door saying, you didn't tell me. Even though I can tell you ignorance is not going to be an excuse. You can, why don't we hold them for the end? Yeah, only because I think it'll just make the flow of it a little bit better. But so be sure to keep it in your mind, though. So I want to talk to you about another implication on this tax bill that I talked about with the double payment in that 1 year, as well as taxes when it comes to required distributions, period. So all of a sudden, you've got new taxable income that you didn't have the year before. The government's forcing the money out and to become taxable income. That's what's actually happening. It has an implication on your taxation of Social Security benefits. So just keep in mind that when you're raising your income, you potentially are putting yourself into a higher tax bracket. That's unavoidable. You're also potentially bringing in more income that the government says, we now will tax your Social Security to a greater degree than before. Back in 1980, Alan Greenspan put together a commission, put together by Congress, that said, we need to shore up the Social Security financing system. I think it was 1980, 81, 82. And he put together this panel, and they came up with multiple reforms, one of which was we were going to increase payroll taxes over the course of time. That happened. But also they said, we're going to take people who have other forms of income, any other form of income, frankly, and we're going to add it all up, and we're going to find out if they've got enough income in the eyes of Congress to actually then begin to tax a portion of the Social Security payments that you get, which was really a tectonic plate shift when you think about it. This was money that you put away on your own into the system, and now you're getting the money back again, and they're going to tax you on the money that you put in before that you were taxed on. So this is truly a form of double taxation, but they needed to find money from somewhere, and they found it from people who had other forms of income. So I want you to know this IRA distribution, these retirement distributions coming out as required distributions, could actually make it so that some of your Social Security that wasn't getting taxed is now partially getting taxed. And it goes from zero tax if you don't have a lot of other income, up to 50% taxed, up to 85%, which is the maximum. Maximum is 85%. And the income, they call it your provisional income. And it's basically everything you make all the other forms of income, plus half of your Social Security. They add it all up and they say, okay, let's look and see how much we're going to tax your Social Security. So just be aware that that year that you're getting your required distribution for the first time, talk to your accountant just so you understand what your tax bill is going to look like. I will throw, well, we'll talk about it afterward. I'm going to throw one more implication that comes in with higher income. So before I get to that, I want to go through a couple of different issues with required distributions when the person dies. So you now have an IRA, you pass away, and the people inherit your money. And the default person who inherits your money is presumably you're going to be your spouse. If your spouse survives you, your IRA becomes their IRA. That's an option. You literally can take the deceased spouse's IRA and just combine it in with your IRAs. Becomes your IRA. And then the rules about required distributions are simply based on your life. So if you have an IRA, if you're a younger spouse than the person who died, you're going to be waiting around for your required distribution to restart again. And so there's a benefit to rolling it into your IRA and then waiting for more tax deferral to happen before you'd start to make your required distributions. And so merging the accounts together is completely acceptable. It's very, very different when the inheritor is a non-spouse. So a non-spousal beneficiary has a completely different set of rules. A non-spousal beneficiary, they inherit your IRA, and forevermore, that IRA is known as the inherited IRA from the deceased person. It might be a deceased father, it might be an uncle, it might be an aunt. But that person's name, the deceased person's name, is always formally on the actual IRA's description, the ownership. Okay? And you then have to take out money on an annual basis out of that IRA, no matter what your age is. So if you're a 40-year-old and inherited money from your deceased father, you will forevermore have the option, and I will say option, of taking out a minimum amount of it every single year based on, again, a table, a mortality table. It's not the one that I showed you before. It's actually called the Single Life Table, and it's in the same publication 590. You have to manage that yourself more often than not. The custodians are not tracking that. It's very important for you to know you have to take it out. And the dollar amounts are smaller in terms of percentage because you're a heck of a lot younger. The government says, oh, okay, you're 40 years old. Your life expectancy is, 40 plus years, 50 years. So now imagine that divisor being a bigger number. It's a smaller percentage is coming out. And then every single year you have to adjust it.
You use the word option.
Well, here's the option. The option is that if you inherit an IRA, you absolutely have the ability and option of pulling all the money out, doing whatever you want with it. Or you can decide to stretch the IRA out and have the payments be minimal payments out of it. But you have to take a payment. If you fail to take those minimal payments, if you forget to do it or never do it, then you have 5 years to deplete the entire thing and pay tax on the entire distribution. So you have, the rule is this: somebody dies this year, you inherit the IRA. You then have one whole calendar year, the next calendar year by December 31st, to make your determination if you're going to take out minimal payments, the required minimum for life. If you forget to do that or fail to do that, then you are going to be on a 5-year clock, and you must take it out by the end of the 5th year. You must take the whole chunk of money out of the IRA. And taking that whole chunk of money out of the IRA means that all of that will be taxable income. So it could be a suboptimal tax strategy to just say, I'm just taking it all out. So, a lot of people, when they inherit money, even in the form of an IRA, they take it out. Why? Because it's free money. They're going to pay the tax, and they want the after-tax pot of money for whatever purpose. Pay down debt, put a kid through college, down payment on a house, whatever it happens to be. vacation. There are lots of reasons, some good, some bad. That's what happens. The vast majority of those people do take it out. The best tax strategy and the best long-term planning strategy is to encourage a person who inherits an IRA to take out the required minimum and required minimum only, allowing for the majority of the money to be invested for a long period of time. Let's hold questions until the very end, if you don't mind. So that's what happens with a stretch IRA, but recognize that you have a rule. The rule is the end of the year following the year of the death, December 31st. That's the clock has started ticking. Then the whole next year follows. You have until December 31st to finally get it into an inherited IRA and begin taking your required distributions. Or you forget to do it, then a 5-year clock starts and you have to distribute it all in 5 years. So I kind of did a prelude to that. I will tell you the last point on this non-spousal beneficiary is you can never, ever, ever, ever merge your inherited IRA or inherited IRAs. Let's say you're a really loved heir and everybody on earth keeps giving you their IRA when they die. All of those IRAs will be separate, 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 separate for the rest of your life. You cannot merge them together. You also can't take your inherited IRA and put it inside of your own IRA. They will always remain separate, and they'll always have the name of the deceased person in the formal name. Okay, I'm going to talk about one last thing and wrap up the program, and then we'll get into Q&A. This thing is called the qualified charitable distribution. A lot of words for basically saying you can take money up to $100,000 a year, and you can literally donate it directly to a charity out of your IRA, and that can satisfy your required distribution. And you sit there and think, okay, well, that's good. Let's talk about what it actually has accomplished. Well, first off, it accomplishes your charitable intent. We don't want to gloss over that because that's the whole point. But there are some tax benefits to it. And you probably all, generally speaking, all get mailings at the end of the year that remind you of this wonderful opportunity from all these nonprofits, okay? Did you know? And so then I get a bunch of calls usually in November and December. And then I try to simplify my answer, and it never comes off simple. Okay, so the charity receives the money. That's great. You satisfy your required distribution. Well, that's good in the sense that it's not income on your income tax return. Because you don't put it on your income tax return. It's not a donation that you get a deduction for, because you're actually sending the money to the charity of money that was ultimately going to be taxed. That is your deduction. You're not going to get taxed on that money. It's not income. So it's not a charitable deduction, and it's not income. It's almost like it didn't happen. The government just is saying, you don't need to do your required distribution. So this is the reason that people talk about it being beneficial. It lowers your income, which has a kind of a myriad of impacts on your tax return. Because think about what were actually the alternative to this. You take money out of your IRA, it satisfies your required distribution, it's taxable income. You take your money and you donate it directly to the charity at that point. You then get a deduction for a charitable donation. So money in, money out, there's nothing that's happening except every single one of these things are affected by your adjusted gross income being bigger. So your adjusted gross income went up, Medicare taxes are higher, Social Security tax is higher. You don't have as many deductions on your Schedule A. You still got the charitable deduction, that's great. But you have had an impact on your overall tax bill. If you avoid that by just donating directly to the IRA, it may, to some extent, have some benefits on taxes. So the last slide is to just drive home the point that the penalties are huge. Now you have zero excuse for forgetting your RMDs. 50% penalties are completely avoidable. And now I'm totally happy to answer any questions because I'm sure you've got very specific ones.